earnings season is here.
The earnings are starting to pour in.
The numbers are holding up better than expected.
Sorry, business isn't all that bad.
Bloomberg breaks the numbers first.
Netflix earnings going to cross the wire.
A big beat. Stock is up more than 8%, coming in stronger than their rivals.
With exclusive expert analysis.
Finally back to growth.
The mother of all opportunities.
What is the industry to watch? That's where the rubber hits the road for Goldman Sachs.
It's going to be a really interesting earnings season.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
All right, Amazon shares are falling about 10% after disappointing a sales outlook. The market cap just sitting at $1 trillion. Joining us now, Dan Morgan, Synovus Trust Portfolio Manager. He owns Amazon, Microsoft, and Apple, and did own Twitter before it went private. Hey, Dan, what do you do with Microsoft? What do you do with Amazon right now?
Well, Amazon's a tough situation, Alex, because coming into this report, we kind of thought that they had right-sized their company after the pandemic. We know that they increased their facilities, they added workers to kind of work through the pandemic in terms of the increase in demand, and then they kind of downsized themselves. And then they came in with a relatively good quarter on this third quarter. Revenues were up 15%, AWS was up 27%, but obviously the guidance going into the holiday quarter, the fourth quarter, with revenues only growing 2 to 8%, that's a little bit discouraging because you would have hoped that you would have seen more of some positive momentum carrying into that fourth quarter. We own the stock. It's been on our buy list for a very long period of time. I still think the fundamentals are solid in the company, but it's going to take them a little bit more time to kind of work through this slowdown that we're seeing in terms of consumer expenditures.
Dan, how long does this downdraft last for these tech names? Is this going to be a multi-quarter phenomenon?
You know, Guy, that's the million-dollar question. I've done a lot of interviews, talked about the tech wreck back in 2000. I was managing money back then compared to today. It's nothing like that. I think what we really have to focus on is the Fed. Even though it's redundant, the reality is that as long as the Fed is going to continue to raise interest rates, there's always going to be concerns that IT spending is going to slow down. That's the big issue. Once the Fed stops, once we can see that line in the sand, which I'm hoping into the spring or summer of next year, I think we'll start to see the chip sector recover, which will then lead to the broad-based recovery in tech.
Well, you know, to that point, Dan, we have seen investors come back in. Just look at the triple Qs. We have seen flows start to pick up. I'm wondering where you see the flows going for that. Because if you just look on a valuation level, you know, Amazon is trading at 85 times earnings. You have Microsoft, though, at 24 times. Like, what's the appropriate valuation for these guys?
Yeah, I mean, I think people putting money back into that sector is due to the fact that the stocks have pulled back so much and they seem so cheap. But you're right, based on valuation, well, the earnings growth is coming down, so the multiple is going up. If you look at the S&P 500 information technology benchmark, it trades at about 20 to 24 times earnings. It's a little bit above the S&P 500. So there may be some people that see some value in there in the fact that the tech sector is trading in line with the S&P 500 in terms of valuation. And they're saying, look, we know there's going to be some more bad quarters. We know it's going to take some time to get back on track, but we're willing to go in.
Dan, can I just buy the basket anymore? To Alex's point, the variation in some of these reports is really quite significant. Can I just buy what used to be the FANGs or used to be a basket of technology stocks? Do I have to own individual names? And is it easy to pick winners and losers?
Well, Guy, I think you do have to be a little more selective. I think the days of just buying the FANG stocks and everybody doing great is over with. Obviously, the Apple report was better than the report that we saw with Alphabet. It was better than some of the other reports. IBM had a good report last week, believe it or not. No one really talks about that stock, but it's actually up for the year when everything else is down. So I think within tech, you do have to be careful. You do have to pinpoint the names that are able to do extremely well in this environment. Not everybody's going to do great. Like you said, you just can't throw a dart, throw them at the FANG stocks and expect them all to go up.
Hey, Dan, last question. We got about like 30 seconds or so. What would you be selling right now?
Well, within the tech sector, I mean, it's kind of tough. I mean, I think the whole group has been knocked down so much. There's nothing really specific that I would be selling in the group that I think is like a big red flag that things are going really negative. I will say this, Alex, if you look at the ad spend rates in terms of internet, that is definitely slowing down a lot. And you think of a Snap, you think of a Twitter, even though they've gone private. Google obviously is going to see a slowdown with that. Facebook, those might be some names that I would be a little bit more cautious on. where I'd be more focused on companies that are focused on the cloud. AWS is a good example of that with Amazon. We've got Azure with Microsoft. So that might be a little bit of way to distinguish between the two, where the growth is and where the growth is deaccelerating.
Dan, great to catch up. Thank you for joining us.
Thank you,
Come back
Guy.
again soon. Dan Morgan, Synovus Trust Portfolio Manager. Thank you very much indeed. This is Bloomberg. So coming up, long-term inflation expectations continue to pick up. We're going to discuss what this means for the Fed as it meets next week. Michael Schau of Market Field Asset Management is joining us next. This is Bloomberg.
Stay like Bloomberg.
We're about an hour into the U.S. trading session, still up pretty strongly on the day. Bloomberg's Abigail Doolittle tracking those moves. Abigail?
Yeah, we're looking at a really strong risk-on day at this point, Alex, capping off another week of gains for the S&P 500 and the other major indexes. The S&P 500, as you can see, up 1%. We have the NASDAQ up more, but still, we have the equal weighted sense shown by the Dow outperforming, up 1.6%. And the big contribution to all three indexes, of course, is Apple, up 6.7%. Of course, their September quarter was good. They're talking about holiday weakness. But relative to Amazon and some of the other mega cap tech companies, this stock, this company right now really is trading as though it is the best house on a bad block. For PMs that have to be invested in mega cap tech, they're going to pick the best one, which right now is Apple. So again, a big reward there. Now let's take a look at a really interesting divergence. On a year-to-date basis, take a look at ExxonMobil and Chevron. Both of these companies just reported on the day. They're up 1 or 2%, no big deal. But what they did do on a combined basis for the last quarter, $31 billion in profits. That's $14 million per hour. Really just all that rise, that increase in oil flowing to the bottom line. Record profits for ExxonMobil, second best profits ever for Chevron. Take a look at Amazon on the year, down 40%. This is a divergence. Energy is the only sector up on the year. The rest of the sectors are down in a big way. Amazon, again, down 40%. They, of course, that stock is tanking today on their prediction for a very rough holiday season. So this is what we're looking at relative to market cap losses. For Amazon, single day, $203 billion lost. Alphabet, $120 billion. Microsoft, Meta, and then take a look at Apple, again, the best house on a bad block, $60 billion. Thereabouts. And then finally, Alex, let's take a look at what's happening relative to the BOJ's decision to really stay the course relative to being more accommodative, really an outlier relative to the global central banks. The rest of the global central banks, for the most part, hiking. The BOJ staying accommodative. On this, we have the dollar-yen rallying. We have the Japanese 10-year yield, the JGB, down. It's actually about flat right now. But take a look at the 10-year yield here in the U.S. It's up 6 basis points. And it's interesting also, Alex, that's not acting as a tailwind or a headwind to stocks. Investors really in a bullish mood. They want this bear market rally to go on.
Yep, they do. Bank of America, though, says it's still sort of a bear hug at this point for U.S. stocks. Abigail, thanks a lot. Bloomberg's Abigail Doolittle. All right, let's get to the data from this morning. U.S. PCE showing signs of acceleration in September that really reinforces the Fed's tightening plans ahead of its November meeting. Plus, you got a Bloomberg survey of economists this week showed they expect interest rates to eventually hit 5% and tip the U.S. economy and global economy into a recession. Joining us now, Michael Shaul, Marketfield Asset Management CEO. Michael, great to see you. Thanks for joining us.
Nice to be here.
Okay, let's just talk to the data today. I mean, the ECI was pretty high. You still had a pretty strong core PCE. How does this set us up into the Fed next week?
You know, the data was pretty much in line of expectations. Expectations were for strong numbers, and you got strong numbers. So I think it keeps things where they were, yesterday, which is people are anticipating another 75 basis point hike. I think the Fed tries to keep its choices open for December. My guess is that Powell will signal a willingness to hike 75 basis points, but we'll try and say that it's not baked in, that they will be responsive to whatever data comes in. And, as I say, I don't think that comes as any great shock to the market at this point.
Christine Lagarde tried that yesterday. Got some really tough inflation data out of the Eurozone today. German inflation, we're back to levels we haven't seen since the 1950s. The last time we had these kind of numbers, Michael, was when we had West Germany and East Germany. Do you think inflation's going to be stickier than we all think it is?
Yeah, I think for sure. At the same time, it can come down at the headline rate. It can even come down on the core rate, and it can still be sticky. I wouldn't be surprised to see headline CPI improve from 8 and change to 5 and change, and everybody to get excited about that. But then getting it below 5, when you look at the sort of various components, really becomes quite difficult.
Do you think that we hit the terminal rate 5%? By March, like the survey said, and then we tip into a recession? Do you think that that's going to be?
I think it depends on whether the market blows up between now and then. I've been.
What does the blow up look like?
S&P well below 3,500, S&P 3,000, and I think crucially credit markets non-functioning. An inability of corporations to roll over debt. is a much bigger red line for the Fed than the S&P at a particular level. So I've always taken the view since the Fed started hiking that financial market risk is actually greater than economic risk. That's because the Fed was so far behind the curve before they started hiking, and financial markets were themselves so extended. And I still think it's a foot race between where the Fed wants to get and the ability of financial markets to withstand them.
Michael, let's talk about the moment when the Fed goes to doing 50 basis point hikes rather than 75 basis point hikes. Would you anticipate that risk assets, equities, rally at that point? And do you buy that rally?
I don't know in terms of whether I anticipate it. Sure. I think it depends on what expectations are. In other words, if the futures market has baked in a 50 basis point December hike for a week and then the Fed does 50 basis points, I don't see why the market would have a dramatic reaction to that. But generally, no. As I say, I think you've got to look at overall market conditions. We felt like 2-3 weeks ago that the market had gone down far enough for the time being. That mattered to us more than what the Fed was going to do in October or November. And I feel the same way about December. You've got to look at where the market was. If the market was, S&P was already above 4,000, 4,200, I don't want to be buying that.
So, okay, to that point then, do you think that next week we start to hear more of a potential downshift for the Fed? Not a pivot or a pause, just no longer the 75 bip hikes, more to 50, more acknowledgement that the economy may be a little softer than we think. Do you think we get that?
Yeah, I mean, I think so, but I think it's also because, look, whether they stop at 4, 4.5, 5, 5.5, you're getting closer to the levels where a pause would still be hawkish monetary policy. You've done the hard work. You'll be above 4%, and with a December hike taking you beyond that. So it becomes relatively easy for the Fed to signal that it's not hiking by 75 basis points a meeting. If they want to continue hiking at 75 basis points a meeting, pretty soon they'll be at 6%.
Got to ask about tech, Michael. What do you make of what we've seen this week? Yeah. People are calling it the tech wreck. Is it over yet?
Look, I think it's the end of technology leadership. I think that really matters because there's trillions of dollars of market cap stuck in a sector which is now underperforming, significantly. I think people sort of forget how strong the Nasdaq 100 has been as an index over the last 20 years. It's had 2 down years since 2002. And one of those was less than 2%. It's only 2008 where investors in those sorts of companies had a horrific 12-month calendar period. And they're heading for one in 2022. So I think it does matter. And I think it's, in the case of technology, it's not just financial market conditions, it's actually corporate conditions. And to me, I think the big story going forwards is that non-technology sectors may start to benefit from outflows out of technology, and that might matter as much as the sort of headline whether people are buying index level positions or selling index level positions.
So I'm going to dumb it down for a moment, but does that mean you got to sell Amazon, buy Chevron? Like
I think it would have been an excellent idea a year ago.
Okay. So
but yeah, I think that once leadership is lost, it normally takes place in a bear market, and sectors which have been really popular and done really well for years, tend to lag. So, if you sold technology in 2001, you were happy in 2002. And if you didn't buy it back until 2007, you had no real cause for regret. Tech went up during that period of 2002 to 2007, but it wasn't where you wanted to be if you really wanted to outperform. So as I say, I think most of those large technology companies are no longer leadership. It's realistic to expect them to lag in terms of performance over several years. Over several weeks, they could do quite well.
Michael, if that was the trade last year that you should have made, what's the trade that you should be making now for next year?
I still think that the global cyclical performance is, that risk is greater than I think the reality. I think the big question for the next 12 to 18 months is, are we watching the dollar peak? If we're watching the dollar peak, then all sorts of global equities and dollar-sensitive portions of the U.S. market start to become, more attractive. It's too early to say that we saw the peak at 115, but it's definitely, it's definitely a possibility. And I think getting the dollar right is going to go a long way to getting a portfolio right between now and the end of 2023.
A portfolio right, how do bonds play into that at this point in credit?
I don't think the bonds are particularly sensitive to where the U.S. dollar is, but I think going forward, I'd probably rather take duration risk than credit risk. I think the risk that you have now is that during a period in which the Fed's on hold and interest rates aren't necessarily going anywhere, that corporate conditions start to deteriorate and credit spreads still have a long way to potentially widen from where they are right now.
Michael, thanks for stopping by. Always appreciate your insight. Thank you very much indeed. Michael Schell of Marketfield Asset Management. What have we got coming up for you? It's been 10 years since Hurricane Sandy battered the United States, inflicting over $70 billion in damages. It also killed significantly 200 people, over 200 people. Chuck Watson, disaster modeling specialist at Enki Research, is going to join us about why it's so tough to draw a link between climate change and these storms and what these monster storms teach us about where the climate is going. That's next. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. The husband of House Speaker Nancy Pelosi was assaulted in a break-in at their home in San Francisco today. Pelosi was not there at the time. Paul Pelosi was taken to a hospital and is expected to recover. According to the Associated Press, he was severely beaten. Nancy Pelosi's office says the intruder was taken into custody and the motivation for the attack is being investigated. In a new Bloomberg survey, economists predict the Fed will keep laying groundwork for interest rates to reach 5% by next March. They expect that to likely trigger a U.S. and global recession. Next week, the economists see policymakers raising rates by 75 basis points. That is for a fourth consecutive meeting. And a showdown over college affirmative action is set for Monday at the U.S. Supreme Court. It pits the court's liberal wing against Chief Justice John Roberts and his dream of a constitutional ban on racial preferences. The court will hear arguments on admission policies at Harvard and the University of North Carolina that could lead to fewer black and Hispanic students at selective schools. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Alex.
All right, Rika, thanks very much. So Saturday marks the 10th anniversary when Superstorm Sandy slammed into New York City. Now, the storm was historic. I was down on Wall Street reporting from there. We're going to take a look at some of the lessons that we learned in 10 years since Sandy.
Hurricane Sandy slammed New York City on October 29, 2012. The superstorm led to the deaths of 43 New Yorkers and caused about $19 billion in damages.
The immediate reaction is let's not let Sandy happen again. And the reaction should be let's prepare for the next disaster that might be a lot worse.
We're talking about a global city, a city that's essential for the financial well-being of not only the U.S. but the entire planet. The responsibility has to lie at the highest level of the federal government.
The aftermath of Sandy devastated homeowners and the city's public transportation.
We had salt water coming in from the ocean, which was highly corrosive to subway equipment because of the salt on the infrastructure.
New York City has 520 miles of coastline. Most of that coastline is primarily made up of low-income communities of color in the so-called outer boroughs, and these are working families who are on the front lines of extreme weather, whether they like it or not.
According to a recent New York City Comptroller report, the city has only spent 73% of the $15 billion in federal Sandy recovery grants.
Our bureaucracy is not designed for emergencies. It just isn't.
We're treating climate adaptation as though the goal of climate adaptation is to prevent change. And the goal of adaptation is not to prevent change. It's to choose the changes that we want to see.
While we were waiting for something like Sandy to come again, we are experiencing other storms like Hurricane Ida, which happened last year. Although we are preparing, we are being caught off guard for what is happening next.
The real estate market continues to boom in the 100-year floodplain. According to the Comptroller's report, $3.1 billion in annual projected property taxes will be threatened by increased flooding, with 30% of public housing stock at great risk by the year 2050.
100 years from now, sea level will rise. We don't know exactly. It could be anywhere between 2 feet and 6 feet.
And the goal should be, how do we build thriving communities that are going to be sustainable and safe for the next century or beyond?
I think New York City is getting ready for a storm that's even more powerful than Hurricane Sandy. If it happens in the long term, I think that we will be more ready with flood-resistant measures. But I am not sure that if it happened tomorrow, if we would be prepared.
Well, some scientists say that there is a direct correlation between climate change and the intensity of hurricane season as global temperatures rise. What's the permanent damage here? You got Chuck Watson, NK Research disaster modeling specialist, says the connection isn't so clear-cut. He joins us now from Savannah, Georgia. Chuck, what is the correlation then?
Well, the problem is that we know that based on modeling and just common sense that if you get more energy, a warmer atmosphere, a warmer ocean, you should get stronger storms. But it gets complicated because the way that the atmosphere changes isn't so straightforward. So the current consensus is that we think that there'll actually be fewer hurricanes, but the ones we do have will last a little bit longer, be a little bit stronger, and cause a little bit more rain. And of course, that little bit makes a big difference when you're hitting, say, a city like New York.
Chuck, are we more aware or more vulnerable here You talk about the fact that we could just see bigger hurricanes. What does that actually mean in terms of how we're going to feel it on the ground?
Yeah, and it's important we keep all this in context. And again, I don't want to come across as minimizing climate change, because it's a very serious problem. It's going to get worse over time. But think about a storm even like Sandy, and okay, it caused $70 billion roughly in 2012. Because of housing market changes, that would be maybe $90 billion today, plus more, as your package said, a little more. There's more stuff in the way. But even if it's 100 or 120 billion, that's just a fraction of a percent of U.S. GDP. So in terms of being able to put some resources into mitigation, trying to do something about climate, sure, we absolutely need to be doing that. But climate change is really a symptom of a broader problem, and that's our systems of governance just can't handle these kind of big disasters and crises, whether it's climate change or the geopolitical situation. So, it's a tough balance to try to figure out how do you deal with a problem like climate. It's very complex. It's economics, it's social policy, it's resources, and it's governance is how you fix those things.
So, Chuck, to that point, who winds up paying for all of this? Insurance companies, taxpayers? Like, who winds up footing the bill for all of this disruption then?
Yeah, that's a great question, Alex, because what ends up happening is it's almost a game of musical chairs between the private sector individuals, insurance, government. Nobody wants to get stuck with the bill. And so what you've seen over time is where in maybe the 60s, you would figure that roughly 50% of the costs of the impact of a storm was covered by insurance. Well, the last 10 years or so, we're seeing those numbers drop to as low as 30%, or even in the case of a Harvey, where most of the damage was flood, 25%. So you look at what's happening in Florida. Florida, the insurance industry is pulled out of the state in a lot of cases. And so you now have an insurer of last resort. You've got the state acting as a backstop for the insurers that remain. So that's where you start to transfer risks to the broader society through the taxpayer.
Yep, we're waiting to see exactly what Ron DeSantis is going to do on some of these issues. Why is it easier, Chuck, to draw a line between climate change and droughts and forest fires and what we've been seeing in California, what we've been seeing here in Europe? Why is it easier to draw that line rather than draw a line between climate change and hurricanes?
Well, hurricanes are such a complex phenomenon, and part of the problem is we don't have a lot of good history. Just as an example, the National Weather Service, NOAA, has an ongoing program to try to look at the history of hurricanes. In other words, how have they changed over time? And they just finished this year a big study of just the period from 1966 to 1970. Believe it or not, they found 14 storms that had been missed during that time frame to add to our record. So when you come in and say, oh, we've had more storms this year, well, we don't really know that for sure because the historical record's kind of incomplete. And it's a fascinating project. They're even going back to looking at ship captains' records from the Spanish galleons when they were going back and forth, because we really don't have a good handle on what the natural variability of hurricanes is. And when you're talking about things like wildfires, droughts, there are other ways we can look at that data. We can look at soil records. We can look at the records of ice cores to see how much ash was deposited in the Arctic so we can get a better feel for what's going on globally. So climate's a fascinating multidisciplinary. It's geology, oceanography, meteorology, sociology, and economics. And it's a very complex issue, and you have to pull data from a lot of different sources to try to figure it out. It's interesting you mentioned California, just real briefly, because I did an analysis earlier this year looking at that, and it turns out that because of the growth in California and the expansion of people, Alex?
Chuck, we seem to be breaking up a little bit, so we're going to leave it there. Thank you very much indeed for joining us. Chuck Watson of Enki Research. The data matters. This is Bloomberg. European close is coming up. European stocks pushing into positive territory. Gap lower first thing this morning. We've been bouncing ever since. Look at what's happening in the States, though, with the Nasdaq. Airbus is the most interesting stock story, I think, in Europe today. We need to talk about what's happening in the bond market. Look at this. Inflation surging in Europe. Scott Sheffield is next. This is Bloomberg.